What's going on, guys? Welcome back to the channel. Doing an analysis today on Google. Loading this up in the stock research tool, looking at three key categories, folks. Our company metrics, which compares the trailing 12 months to the 5-year averages, financial valuations, which looks at all three company statements, and finally, last but not least, we will do a price analysis to find the intrinsic value of this business and what we should be paying for it today. So with Google, interesting business. We obviously had our stock split. And going through the company metrics category really quick, what I'm going to look for is any kind of discrepancies that may stand out for better or for worse. And for better, our PE ratio has been going down from our 5-year averages, which is great. Our EPS is up over our 5-year average from 2.82 all the way to 5.39, so that's very impressive. Same thing with our ROE, it's up, and our profit margin is also up for it. So for the first 4 categories here, looking pretty good. Our revenue pretty high, with our net income sitting at 72 billion, free cash flow 65 billion, and our 5-year average is 37. So we are well above that, folks. Very healthy, a very healthy return on invested capital, as we can clearly see. A really high Allman Z-score and a decent Piotrowski score, sitting at a 7, where we want to see this number between 7 and 9. 9 being the highest number you can possibly achieve. So I know I flew by those numbers, but we are up on a lot of key categories: PE, EPS, ROE, and profit margin. Those are all great things that we want to see, folks. Now, from the detailed perspective, jumping into the financial evaluations of my software here, we're grading this company 8, 9 out of 10. That means they're doing a lot of things right. The only thing that they're not doing right, folks, is their PE 5-year average sitting at 34.41. However, they're making up for it in the trailing 12 months, sitting at 21.27. We want to see this number ideally underneath 22.5. So with Google, if they can justify this 5-year PE ratio sitting at 34, it might be something to overlook and it might be fine. However, we're getting no points there. But in regards to everything else, we are crushing it, guys. We are crushing it. Current ratio is 2.81. So that means they have enough assets on hand to cover their liabilities. And our ROE is sitting above 15%. Our EPS growth is up. Debt to equity is incredibly low, folks, sitting at only 10%. That means they're growing this business through equity and not through debt, which is great because that means the creditors don't have so much of a strong hold on them. And as we turn into an upcoming recession, where it's going to be harder now to borrow money because interest rates are going up and to pay back debt, it's comforting to know that Google is growing their business and not taking on any debt, so they don't have to owe anybody any money. And for a tech company, this is imperative because, listen, research and development is the key cornerstone of this business. So if that slows down, then it slows down, and that's not healthy for anybody. Going into our share dilution, we are buying back shares, which is great. They've been buying back shares 2% over the last 5 years, which is comforting to see. Our return on, our net income is up by incredible amounts. Our free cash flow is up. Our revenue is up, and our 5-year return on invested capital is sitting at 17%. Where we want to see this number is 10% or higher, and we have that no problem. So guys, almost green across the board except for this 5-year PE average, which I could possibly forgive if it makes sense when we do a price analysis. But I'm loving this so far. We are up on our 5-year free cash flow. These are the points that I have to make here. What's sticking out to me the most? I'm loving that we're up on our 5-year free cash flow average. Our debt to equity is low, and we're buying back shares. And obviously the trifecta of our net income, free cash flow, and revenue has been improving over the last 5 years is comforting to see. So Google is doing a lot of things right. Now, finally, and last but not least, we will do a price analysis, and we're going to analyze this business for a 10-year period. I'm going to fill out all of these lovely boxes here, and I will show you what that equates to. So stay tuned. So guys, before we jump into the price analysis, if you're enjoying the video, hit that like button, hit that subscribe button, and share this video with a friend who's looking to potentially invest into Google. And if you're enjoying my process and the software, stay tuned because it's going to be available to you, my viewers and subscribers. This is what I've done, and if you're new to the channel, well, welcome. And here's what I've done. With the revenue growth, I've taking a somewhat of a more conservative approach based off of our 10-year numbers. So I've done 19, 20, and 20 and a half, thinking that they could probably do that over the next 10 years. You know what? I feel like I want to do 18, 19, and 20. I feel like it just doesn't make sense given the scope that it's a $1.5 trillion company. You know what? Maybe we're going to do 17, 18, and 19. How about that? And then we'll go from there. There's probably a lot of runway with this business still, right? As information is just the gold of today's society, and Google is the main provider of all that. So 17, 18, and 19% revenue growth over the next 10 years, a haircut to our profit margin, a haircut to our free cash flow margin sitting at 18, 19, and 20, price to free cash flow, all this lovely numbers sitting below our 20 mark, right? As we have it at 23.50 for our price to free cash flow. I'm going to do 14, 16, and 18, and PE ratio 14, 16, and 18 with a desired return of 13%. I'm going to hit the calculate button, and we're going to load, and this software is going to calculate all these numbers to produce what we should be paying for the company today. Okay, so folks, we're going to jump back into the video. I just realized with my software here, you had to type in Google, like the Google symbol, GOOGL, not GOOG, GOOG. So with that, everything stays the same. I'm going to jump back into the price analysis. Take a look at this. And we are showing that even though the current price is $116, our average calculation comes out to $524 based off of these numerics here. Now, honestly, full transparency, I think I may be a little bit off with our revenue growth numbers. I feel this is a little bit too high. So I'm glad that it showed green. However, I want to give myself more of a margin of safety. So I'm going to go 10, 11, and 12 and see where that leaves us here, folks. Because if I'm getting that much with that margin of safety, if I increase my margin of safety, I want to know what can I push? Where can I push this company? So $280, assuming a 10% revenue growth. And look, this is why margin of safety is important, because we've shown that over the 10 years we do 21, 23% on an increase in revenue. So if I can assume 10% or even lower than that to be paying for this company, to assume a 13% return, this is phenomenal. So I'm going to continue going lower, and this is why my software, this is one tool I enjoy on my software. And if I do 7, 8, and 9, let's see, how low can I go and how low can I pay for this business? So let's see, 164 on the low end. It's currently sitting at 116 right now. So Google is looking fairly attractive to me right now based off what I'm being shown here. And I've discounted the revenue growth by incredible. I've given myself super low revenue, and I think I can probably even go lower. And I've gone lower. But here's the thing, folks. This is the first step. And if you want to get this software here, stay tuned and comment down below if you're interested. And also comment a stock you want to see evaluated down in the comment section down below. But here's the thing with Google, and what we're trying to do on the channel here is give ourselves the ample margin of safety when buying these businesses, because I want them to beat my numbers. And do I think they'll be able to beat 7% revenue growth over the next 10 years? Possibly. Most likely. I believe this revenue growth number is definitely going to slow down based off the market cap of this business. So if it eventually hits 7% at some point in this 10-year period, I'm winning, guys. I'm winning if I purchase this company at 164 or less, where we're currently sitting at. So this is giving me a lot of leeway. Now, if I even just change, let's say if I want to do 20% desired return, does that, I wonder if that changes things on our conservative side by a decent amount. I'm very curious. Look at that, 144, guys, not $91 for 20% return on Google, assuming these numerics here. So it's almost there. It's almost there, guys. But remember, this is the first step. My software has a much more to offer than just what the page you're seeing here, as well as we have the news at the bottom. We have the income statements, cash flow statements, as well as our charts section here, where you're able to visually see a lot of information from free cash flow versus the earnings per share, the dilution of shares, assets versus liabilities, top institutional holders, and its historic performance against SPY, to get the full picture of what these stocks are doing and what these companies are doing to analyze them quicker and more efficiently. So guys, that's the video on Google. Write down the company you want to see analyzed down below. Currently undervalued. This might be something to look into, and I might allocate some capital to it, as well as big tech keeps going down as we head towards, or rather the US heads towards a recession. A lot of people are going to be fearful of these big tech companies because they've been able to borrow money very, very easily. So where does that leave investors? Well, as these prices get suppressed, depressed, and just being fearful, these are strong businesses, folks. And if your outlook is like mine and you're looking way down the line, this might be a great opportunity to pick up some shares. But that's my opinion. Anyways, folks, I'll see you in the next one.